really excited to share with you the national and regional Q2 2023 market report by Dr. Elliot Eisenberg, MLS partner economist, and one of my favorites. I'm Shamika Fox, your Santa Cruz real estate expert and your personalized real estate concierge. For more videos and information on our local Santa Cruz real estate market, don't forget to hit that like and subscribe button. Okay, Q2 2023 National Economic Overview. While many economists have been on recession watch for quite a while, the most recent upward adjustment of 23 Q1 growth from 1.3% to 2% indicates that the U.S. economy, while not stellar, is most certainly very resilient. Recent estimates of 23 Q2 GDP growth are in the range of 2% as well. The much anticipated onset of the recession has been slowed by a number of factors, the most important of which has been the excess savings amassed during COVID, which has allowed households to keep spending despite inflation and, for many families, declines in real income. In addition, there continues to be a virtually unending pent-up demand for services. Households that were unable to travel and enjoy other services during the pandemic have been and continue to spend freely. A great example of this phenomenon is the high cost of attending live music and other events with tickets in the hundreds of thousands of dollars. New car sales plummeted in 2021 and 2022 due to a semiconductor shortage. Now that supply chains have improved, auto sales are picking up quite profoundly, which is surprising given high and rising interest rates. Yet another COVID-induced anomaly. There is also the incremental impact of the recent federal spending bills, including the bipartisan infrastructure bill, the Inflation Reduction Act, and the CHIPS bill. These already have and will continue to encourage a tremendous amount of spending and investment despite rising interest rates. Driven by the above and despite some weakening in 23 Q2, job creation has been well above pre-pandemic levels. Some sectors such as education and leisure hospitality are simply struggling to get employment back to pre-COVID levels, while in other areas such as healthcare, although employment is back to pre-pandemic levels, it is still well below trend. While most labor economists believe that wage growth has peaked, an increasing number of employees seem to be convinced that the labor market will remain tight and that wage increases are still in their future and they are spending accordingly. Finally, because hiring has been so difficult for so long, some employers are still hiring or postponing layoffs even if they are currently overstaffed. Regarding inflation, while headline inflation has fallen dramatically from as high as 9.1% in mid-2022 to around 3% now, this part of the decline has been the easiest of the inflation puzzle to fix, and the remainder will be meaningfully tougher. The reduction in inflation has so far been the result of declining energy prices and related transportation costs, accompanied by a decline in the price of goods as supply chains recover and demand declined, and finally a dramatic slowing in food inflation. Over the last few months, we've seen declining rents and falling used car prices, and those are starting to be reflected in monthly inflation data. However, just as the increase in these areas was almost entirely pandemic-induced, so too have been the declines as COVID impacts fade. Unfortunately, is the remaining inflationary pressures that are not COVID-related that the Fed must now battle, and getting inflation down to 2% will be a struggle. Most of the key measure of inflation that the Fed looks at are all in the 5% range, and while they will fall over the course of the rest of the year, the challenge of bringing them down to 2% will be difficult, and the Fed has made it very clear on several occasions that they will not increase their inflation target above 2%. As a result, it is almost guaranteed that the Fed will raise its rates at the end of July, which they did, and they may raise them again this fall. Other central banks, with the exception of Japan and China, are similarly keeping the pressure on interest rates to quell inflation. Historically, interest rate hikes of this magnitude have more than 3/4 of the time led to recessions, and when they didn't, it's been just a luck of the draw. Moreover, the yield curve has been highly inverted for over a year, and the last 8 times it has inverted dating back to 1970, there has been a recession. As for the scope of the probable upcoming recession, it should be similar in magnitude and duration of the recession of 1970, 1990, and 2000. 2000, a garden variety recession, not necessarily deep or painful, unlike the housing bust of 2008-2009 or the double dip recession of 1980 to 1982. Q2 2023 National Housing Market Overview. The national housing market remains very constrained in terms of housing supply, and that has continued to prop up home prices despite high and rising interest rates. Depending upon how measured, year-over-year home prices are either down slightly or up slightly, but they remain relatively stable, showing that this remains a very strong market and is nothing like the housing bust when home prices plummeted amidst a surplus of inventory. In this cycle, despite rapid and steep interest rate increases, prices have barely budged because of the lack of inventory, while many experts predicted that home prices would decline by 5 to 10%. Now that seasonally adjusted year-over-year prices are starting to rise, it's likely that the worst is now behind us. The other surprise in the national housing market is that the new single-family home construction is picking up despite high interest rates as builders try to fill the missing inventory gap. Additionally, because so many mortgages are locked in at record low rates, higher mortgage rates are having much less of an impact on overall consumer spending. Despite some predictions of a Fed pause or pivot toward lower rates in the near future, it is more likely that we will see one, if not two, additional quarter point rate hikes this year, and that the Fed will leave rates at that terminal high unless and until we enter a recession or we see a pervasive decline in core inflation, and odds are that will happen no earlier than 2024. Q2 2023 Regional Economic Overview. As we move into the second half of 2023, there are indications that the worst of the economic downturn may be behind us in the MLS listings area, especially with the buzz surrounding generative AI and how it is bringing interest and enthusiasm back to Silicon Valley. Many labor economists believe that the tech sector has mostly right-sized and large layoffs are mostly a thing of the past. While the IPO market is certainly not as strong as it was in 2020 and 2021, when interest rates were incredibly low, it has meaningfully improved over 2022. The stock market, and specifically the NASDAQ, has recovered about half of the losses of 2022, which should strengthen portfolios, especially for those employees with stock options. Still, the pandemic shift to work from home continues to have impacts, especially in places like the MLS listings areas where there are more acceptance of and ability to remotely work. For example, office attendance in San Jose is the lowest in a 10-city study by Castle Systems, with Monday office presence at just 12.4% of pre-pandemic levels compared to 19.9% for the other areas. Thursday is the highest day of in-office appearance, and even then, San Jose in-office attendance is just 44% of pre-COVID levels, below the 53.2% in other cities. The struggle between managers and employees continues, with many employers wanting a third day in the office, while employees are generally desirous of two. Other economic headwinds are still dampening growth in the MLS listings area. The failure of Silicon Valley Bank and the resulting banking crisis hit the region hard and has limited much of the lending that startups were depending upon. Bank regulators are likely to add many new requirements and regulations to avoid a repeat, which will undoubtedly keep some startups out of the game. With high interest rates, venture capitalists is harder to attract and much more expensive, and with the prospects of a recession on the horizon, investors and much more cautious. As sexy as tech is and always will be, right now inflation and interest rates might make other more secure options much more attractive to investors. The best perspective is to perhaps consider the economy to be in something of a rolling recession caused by COVID. Tech boomed in the early days of the pandemic while other industries suffered tremendously. Then tech was hit hard in 2022 while other sectors generally saw improvement. Now that inflation appears to be slowing and the stock market is improving, hopefully the worst is in the rearview mirror for the tech sector. That said, recession concerns remain elevated. Q2 2023 housing market overview and highlights. While the MLS listings housing market may have been one of the hardest hit by the combined fallout of work from home, tech sector instability, and high interest rates, recent data suggests signs of improvement. The May 2023 Black Knight Mortgage Monitor cited San Jose specifically as one of the fastest housing markets to recover, with a 1.4% seasonally adjusted single month price gain in May 2023 after having the largest price corrections in 2022. Additionally, recent Census Bureau data show that while large cities have not yet recovered from the population losses sustained in 2020 and 2021, the majority of large cities have seen meaningful improvements. In nearby San Francisco, for example, while there was still a decline in population, it was reduced from 6.8% in 2020 to 2021 to just 0.3% in 21 to 22. The most recent inflation data suggests that the actions of the Fed may be working, and while at least one or more rate increase is inevitable, the likelihood of an additional increase this fall is up for debate. That means that the Fed may now start considering when interest rates can start coming down. Once that happens, we may see activity pick up as interest rate lock-in eases and listings improve. Dr. Eisenberg comments, "We saw the fastest rise in household formation during the worst of COVID, and it is likely that we'll return to more normal levels going forward. This mild weakening of demand, the small increases in supply should improve activity, hopefully without the huge price spikes that we saw over the past few years." Year over year, single-family home prices across the region declined during the second quarter of 2023, with the largest percentage of decline in San Benito County, where prices decreased 10.2% to a median home price of $769,500, the lowest in the region. The smallest year-over-year percentage decline was in Monterey County, where prices dipped 1.9% to $858,000. Home prices remain the highest in San Mateo County, where the median price was $1.9 million and declined 9.6% compared to 22 Q2 prices in Santa Clara County declined 5.7% to $1,775, while prices in Santa Cruz decreased 5.4% to $1,277,500. Now let's look at the townhomes year over year. In Monterey County, they increased 3.4% to $659. Prices in San Benito and San Mateo counties declined about 10% to $540,000 and $918 respectively. Prices in Santa Cruz County declined 8.6% to $78,500, and prices in Santa Clara County remain the highest at $980, a 5.3% decline year over year. Year over year closed sales for all types of properties declined by about 28%, and the combination of lower prices and declining sales pushed overall sales volume across the region down by about 30%. Overall new listings of both single family and common interest properties were down about 28% across the region compared to last year, with the largest percentage rate drop in Santa Clara County, where new listings declined by about a third. Overall active inventories were down across the region compared to last year, with the largest drop in Santa Clara County, where combined inventories decreased by more than 50%. In San Mateo County, inventory declined by about 30%, and in San Benito and Monterey counties, inventories declined about 17%. Inventories remain relatively flat in Santa Cruz County. There is less than a month's supply of single-family homes in Santa Clara County, a 1.4 month supply in San Mateo County, and about 2.5 month supply in Santa Cruz, Monterey, and San Benito counties. On the common interest side, there is less than a month's supply of inventory in Santa Clara County, 1.4 to 1.8 months in Monterey, San Benito, and San Mateo counties, and 2 months in Santa Cruz County. The percentage of listing price received at sale compared to last year declined across the region, but remains strong. Single-family homes still sell for more than their original list price, or OLP, across the region, with the highest premium in Santa Clara County, where homes generally sell for 105% of OLP. Average days on market for single-family homes are meaningfully higher than they were last year, although days on market did decline from last quarter. During 23 Q2, homes in San Benito County generally were on the market for 43 days, up from 19 days last year. Year over year days on market rose 31 days in Santa Cruz County, up from 15 days, to 33 days in Monterey County, up from 19 days, and 21 days in San Mateo County, up from 13 days. In Santa Clara County, days on market rose from 11 days in 22 Q2 to 18 days in 23 Q2. I'm Shamika Fox, your Santa Cruz real estate expert and your personalized real estate concierge. If you'd like more information, please feel free to reach out for a confidential complimentary consultation. I would love to hear from you. I hope you're doing great, and I hope you are making it a great